Overnight, the Bank of Japan has adjusted their monetary policy a little bit. We're going to have a look exactly at what they've done. And is the UK heading for a recession? There's some data that suggests that it could be sooner rather than later. And today's Trading Takeout is going to be why sometimes it's just easier to eyeball a chart rather than getting too complex to try and understand where the market's going. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. Now, here's something that I wrote yesterday with regards to the UK rushing towards recession. I do write it online. If anyone follows me on Twitter, I'm not going to promote it here, but this is a perfect sort of synopsis as to why there's potential for the UK to be entering recession. And it's from a data perspective rather than saying, oh, everything feels bad, let's cry about it. Effectively, it comes down to the contraction in the money supply. Now, part of this is due to the Bank of England aggressively, really, really aggressively selling off their QE bonds, basically. But other parts of it is due to actual credit contractions within the economy. So if we scroll all the way down here, for example, number of mortgage approvals in the UK fell further in September compared to August to around 43,300, down roughly a third on this time last year. Market's still in deep freeze. Transaction levels are now so low that last month mortgage repayments outweighed the value of new mortgage debt taken out. Again, the sort of thing we haven't really seen since the 2008 to 11 downturn. Now, that is pretty terrifying. But there is sort of a, other hand here. And it's showing that the Bank of England's policy is in fact working. At the end of the day, we have a very, very overheated housing market in the UK. It always is overheated because people love to shove their wealth into it. Now, in my view, personal view, that is, I think it's a good thing that the housing market is slowing down considerably. But for many, they're not going to like that, especially from a political perspective. So it does throw some uncertainty and some volatility, I guess, onto the political situation of the UK. Of course, there's a general election next year. And the Labour Party are going to have to do a hell of a lot to try and remedy this situation. I don't think they will, purely because they are pretty much the same as the Tories in the economic sense. The Tories have printed the most money ever. Everyone says they're right wing, but they're very much left economically. Printed the most money ever and handed it to people. So that's a very left-leaning policy. Now, this is also another interesting point. The 12-month growth of household M4 is at its lowest since records began in September 1998. And the 3-month annualized rate is even weaker. So it's basically showing that people aren't taking out debt effectively. They're not using credit lines. They're not using anything. And this is having an impact, of course, on how credit is flowing through the economy. Credit is a big, important part of the economy. If you correlate GDP to, debt, basically, they pretty much go one for one. So the more that GDP increases, the more debt increases. Now, this tends to be a big function of mortgages, which I think is ridiculous. A mortgage is basically taking out a load of debt. The most debt most people will take out in their lifetimes, then just holding it in the ground. It's crazy, but that's the world we live in. Now, if there's a wealth effect that is generated off of mortgages, off of the housing market, then that's bad for the wider economy. The perception that we have, psychological perception, is that if the housing market's going up, everything's good, when in fact, it's not necessarily that relationship. So the UK and other economies are probably heading for a recession this time next year. I would say that the UK could be hit quite hard because we have a general issue with housing affordability, which translates into pretty much every single facet of the economy. So it's a tough one. I think it's going to be a tough time. Hopefully we are more flexible, more nimble, so that we don't have to adhere to the Stability and Growth Pact now that we're out of the EU, where we have to, limit our deficit spending. We don't have to do austerity again. But we'll see. I don't know if the government's sort of adept enough to be able to realise that. So Japan, and overnight we've had a relatively turbulent change to policy. And effectively what they've had is they've decided to add flexibility to yield curve control. Rather than get into the complexities here exactly of what they're doing or what the outcome is, let's just call it that they've added uncertainty to exactly what they're doing. So everyone's been used to the Bank of Japan running easy monetary policy, which means that rates are low, they'll still print, they'll still keep yields suppressed. And that is basically what yield curve control is, YCC. They pin the belly of the yield curve low, in which case it means that there's no real room for yields to spike or go below. So everyone's nice and certain about what the path is. Now, what they're doing here is they want to make it more flexible so they can change this pretty much whenever they like. The market doesn't like things like that. It's less about where it moves to and more about, okay, well, we don't really know what's going on now, so we're more uncertain. And this is the resultant effect. So if we have a look at dollar yen here, I've just typed that in wrong. Dollar yen, and I'll switch to this tab. You can see the spike. The market sold yen off, bought the dollar. Okay, so obviously that leads to the spike in dollar yen. You can see exactly where that happens here. Interestingly, there was some lead up to it, but this was the actual announcement, right? So what we've done there is we've nearly taken yesterday's high. I would expect the market to trade lower and then tick up back higher. But this is what happens, when you get a policy which interferes with the natural path of things, it just creates uncertainty. Markets love to be sure about where things are going. It lets stocks go higher. It lets, FX trends continue. And when they're unsure, that's when you get stuff like this happening. This is when you get divergences. You get divergences in belief, and divergences in belief cause a massive supply and demand imbalance. So you can see there that yen became oversupplied and dollar became heavily in demand. So that leads the price up. That is all that we are trying to identify when we're looking at these things, is how big of a surprise or difference is one change from the status quo. That is all that trading is. And then you've got to supply the market with enough, belief behind that for it to actually make the move. That is what's happening. And enough people have to want to buy or sell at a higher or lower price for the market to move. But that is in effect what is always happening. And I think that's really, really an important concept to grasp, is that all we're looking at here is the extent to which the market believes that something has changed. Because markets love certainty, they hate uncertainty. Sometimes all you need is a chart. Yeah, that's today's Trading Takeout. And I think, it's pretty self-evident as to why I think this. Coming on from yesterday's video about the 200 daily moving average, which, of course, we can just show here, but we don't even need that. Let me just sort that one out. You will know what my thoughts on the 200 daily moving average is. Any market that is below it tends to mean that, what have I done here? Tends to mean that things aren't going the best. So we're currently resting right on the 200 daily moving average on the NASDAQ. What that means is that we could be in for a trend change. It could be in for a bit of a regime change. Now, even if we were to disregard that, where would you guess or have a bet on the market is headed, judging from this being the top in July to where we are now and how this currently looks like, especially with this momentum from last week? Where would you guess? I know where I'd guess, and it would be continuing all the way down. We're at peak rates now. The thing with stocks is that they tend to actually become more volatile to the downside as rates start to get cut because things are not going well. The central banks are looking to have to liquefy the economy, liquefy the markets. And the reasons for that tend to be, data is absolutely awful. And the market is pricing something bad happening, whether it's a liquidity event, a financial crisis, it doesn't really matter, just something bad is happening. And, my first eyeball of this, I was like, well, if we take even there to here, okay, where's that measured move? What does that look like? Oh, it kind of looks like we're heading down to there in terms of the same leg. We've held up right here. It's at broken resistance turn support. You can see the tone of support there. Where do we go now? And it's almost like the opposite move here. Look, so here we had the rally down, up. Here we're going down, up, and then down. And that's the way that I would look at this market, looking purely at where the momentum is. And the momentum right now is down that way.